Recording in progress.
Good morning, everyone. I'm Vince Lancy. Today's market rundown will be discussing the next $500 in gold, as well as the next $100 in gold. Before we do that, let's look at the markets themselves. The dollar is 101.86, up 26. 10-year yields are 380, up 2 basis points. The S&P 500 is 5698, down 20 handles. The VIX is 19.74, up 83 basis points. Gold is 26.44 and change, down 13, hovering relatively close to the lows. Silver, 31.45, down 36 cents. Copper, 4.55, down over 8 cents. That's almost 2%. Gold-silver ratio is a little stronger after having a nice softening yesterday, 83.99. WTI is up 28 cents at 72.05. Natural gas is 270, up 2 cents. Bitcoin is 60,664, up 40 and change. Ethereum is 23.54, down about 9. Palladium is down 26, and platinum is down 24, 992 and 984, respectively. Grains are mixed. Okay, let's start the topics. Before we do start the topics, yesterday we discussed oil. We discussed the OPEC frame, and while the Wall Street Journal sticks by their story, there are some pretty credible people out there, or at least people from OPEC Plus itself, denying that it's true at all. So you're doing a little bit of he said, she said here, and obviously from the West, it benefits us to see OPEC frame because that means lower oil. And OPEC, whether it's true or not, is going to deny it. So we really can't be sure of what the truth is anymore, but that's part and parcel for the course these days. All right, today we're going to talk about the next $500 and the next $100 in gold. And also in premium, we have the analysis covering the next 3.3 billion of inflows into gold coming today. Now we're going to have to use the whole screen today, no ticker, because it's a very chart-oriented demonstration. Here's the first page. The oil's very dangerous situation. That's the Strait of Hormuz, with the red marks are Iranian oil facilities. The other news is yesterday, Costco announced they're going to start selling platinum bars, and we have that story. We actually wrote a story up on that and sent that out to people this morning. And yesterday's Wednesday PM post has all the good stuff that we talked about yesterday in one place. To the topic at hand. The chart you see there is essentially a timeline of events that we've talked about between the beginning of this most recent rally and today. Now, let's get to it. The gold market has had a tremendous run-up starting in November of last year and picking up steam in March of this year. The initial buyers bought for de-dollarization reasons, central banks looking to get out of US dollars, and BRICS countries preparing for a multipolar world. Those buyers are still buying and will likely be buying for years to come. The next cohort of buying came from macro discretionary funds, which are big, patient, and take positions for long-term ideas. While not as big as central banks, they are as smart and know a thing or two when they see it. Buying alongside them were China commercial banks and Shanghai traders who understand the policies of their own government, like the China Hunt brother that we've discussed in this space. And they also see the eventual future monetary system playing out. These SGE types should be viewed as PBOC-backed hedge fund types, and they are the ones, incidentally, that inflicted the pain on the bullion banks. JP Morgan was the one that was named there. Okay. That's how we got to where we are. This is where we are right now, and the purpose of this is to talk about the next $500, which should be higher, and the next $100, which could be lower. And it's a reality check going into probably the most tumultuous time in the gold market since 1999 or since 1980. Moving on. Next, and most recently, American small fund buying came in. That group of buyers, including CTAs and ETF buyers, have been really just starting to buy, as they frequently do during buy season. most of them decided to pull the trigger in anticipation and right after the Fed decision to cut rates came in. These buyers are still active and have about $3 billion to buy this month alone. We go into detail on that at the bottom, but this is no small amount. The last 2 days have shown what that kind of money can do to a market. These are the last 2 days. At 9 a.m., silver's on the left and gold is on the right. At 9 a.m., silver had a mighty spike, as did gold had an even bigger spike. And then at 10 a.m., they backed off almost to unchanged for silver, but gold held its gains for most of the day. Yesterday, silver had a tremendous rally, but gold came in barely up, right? And then it ended up down. So you can see that there is an obvious pattern here for only 2 days, but it's a pattern nonetheless. And that pattern is that these ETF and CTA buyers are piling in droves. It's also a pattern that they're being absorbed. So if you want to look at it as a battle, it's the buyers, how much do they have to buy, how much gunpowder do they have, versus the sellers, who we have no idea who they are. But we're going to discuss that a little bit more. The last 2 days, as I said, are the beginning of a pattern. All these buyers came in for various different reasons, all these various cohorts. The never-ending deficits, the need to de-dollarize, the new mercantilism, which demands all nations reshore their own money. That's right. Reshoring of supply chains is also reshoring of payment chains or money chains. The taste of the 70s and the Fed cuts likely to restoke that inflation. The geopolitical problems, which are auguring in a new Cold War with hot wars in every corner of the globe simultaneously. There is one thing all these buyers have in common. Before we discuss that, this is a chart of the price of gold plotted against managed discretionary hedge fund buyers. As you can see, the pattern simply is this. They vacillate widely, the red arrows. They will have a very volatile time getting in and out of the market. But as we go further and further up the chain, they're much more committed. They may be buying less, but they seem to not be selling at all. That's the pattern. The pattern is that the macro discretionary are in this so far for the long haul. This is not their usual behavior. That's what we're going to discuss right now. The one thing they all have in common, all these macro discretionary guys, the CTAs, the ETFs, even some of the BRICS traders, they're all aware that the US election is coming up. And being aware of that event forces a long fund to think, do they want to take some profits? Some are actually taking profits now on a portion of their portfolio pursuant to making billions in this run-up. Some are also selling as their fiscal year is ending. Sell season is occurring as predicted. The market doesn't have to go down during sell season. But gold continues to rise. Amazingly, right? It rises because of these newer buyers who have been forced to push up their scheduling due to the election and the Fed cuts. In effect, buy season is now overlapping with sell season. These buyers have absorbed, as you saw in that previous chart, the liquidation of some of the bigger players that are selling. We cannot bet on that to keep happening forever. These newer buyers have a different timeline, a different temperament, less settled, and shallower pockets than most of us in this regard. They are your neighbors. They're just normal people. This chart is the $500 higher chart. I posted them out of order, so let me just go through it right now. The next $500 is likely to be higher due to the conditioned global secular changes manifesting in macroeconomic and fundamental behavior of markets. That also happens to be a logical place for gold to go post its breakout from the cup and handle formation. So somewhere between 3,000 and 3,200 if this pattern holds true. And I don't really see any reason why it wouldn't hold true. However, the next $100 can be up or down. It can easily be lower. If more of these macro discretionary funds consider lightening their load before the election, they all remember what happened in 2016 when Trump won. The market screamed higher, only to get stomped on that very night. It makes sense for those of them who are paying attention to the election, as much of a crapshoot as it can be, to say, maybe we lighten up a little bit here and be able to buy the dip if it comes election night. Trade around the core position. This chart here, same chart as before, the macro discretionary originally created by Goldman but marked up by ourselves. This chart here, the purple rectangle, that's where all the small money started buying. They started buying in this area. And that purple line I drew there, that purple line is their average price that they're in. So if you were to aggregate all the buyers between when the CTA started buying and now, anticipating the Fed and the actual Fed cut, their average price is long at $25.50. It stands to reason if we get below their collective average price, they will start selling. $25.50 is a magic number for me as well as for banks that are looking at this. So here's the takeaway. It's not to say we won't rally $100. It's only to say if the next $100 can be up or down, then decide if you're holding on for another $500 or $1,000, as will happen over the next 4 years after the election. Doesn't matter who wins. Or you are in it for the next $100. Because given that the situation we are in is going to have major forces opposing each other, immovable object, unstoppable force, those type of scenarios, given the situation we're in, it's a crapshoot. That's what we wanted to share with you. So the next $500 to $1,000 is higher. Well, let me just put it this way. The next $500 should be higher. The next $100 could easily be lower. Adjust your expectations accordingly going into the election. Remember when Trump got elected? Gold in 2016, gold screamed higher and came back off, as I said. And everyone said, oh, gold's not going to do anything. Well, gold was more strong during Trump than during Biden until the recent last run up. So the gold market did rally considerably under Trump. It just didn't rally that night. As I always say, they don't care about the price. They care about the speed that it gets to the price. Let's go back to that cup and handle chart. It's pretty, right? Ugh, really pretty. Let's hope it continues. Now, before we go on to the rest of the news, I want to talk about silver for 1 second. If you're taking this advice to heart and you're saying, well, what about silver or what about miners? I would say this. It's very possible for gold to drop $150 and silver to be down 20 cents. Very possible. Why? Because everyone, not everyone, but many people that are buying gold did not buy silver. Many of these people bought gold because of the election, because of this, because of that. And many CTAs, not all of them, most are still long now, but many funds are short silver against it. So the initial move in gold, if we have one of those crazy days, silver could really lag. So just as the gold-silver ratio got unreasonably strong in the rally because of central bank gold buying, thus the gold-silver ratio could get unreasonably soft in the sell-off, just like after COVID. So silver is a different animal altogether. If you want to buy silver, wait for gold to drop $100, if it does. Miners, I don't have any expertise in miners, except to say that miners are not in this situation. They're not overbought, but they don't have to be overbought to be sold in an environment like this. I would just throw this out there. If the patterns are repeating themselves, then if/when, and I say when because it's going to happen now, the stock market craps out. The stock market's going to crap out. Everyone's been saying it forever, but I'll tell you why right now. The long bond yield is going to keep increasing as it starts to discount inflation. And as the long bond yield increases, just like when rates went up in 1999 and 2008, eventually the stock market's going to say, that's a nice rate, and they're going to start taking their money out of stocks and they're going to start putting it into bonds. And that will happen to gold too. The whole rate relationship will come back. And when that happens, gold will sell off along with stocks and miners will sell off too. And that's when you buy miners, because gold will drop $100, stocks will drop 20%, and miners will drop 25%. And that's when you buy miners. That's me speaking from a macro tactical point of view. So there you go. Moving on. Data on deck today is S&P final U.S. Services PMI and premium big buying in silver and gold being digested. Now we have a full analysis of that. I'm going to share that with you for a second here, give you an idea what it looks like. We have a summary, the fundamental backdrop, the tactical alignment, the key level to defend in a reversal, and the most important chart in gold and silver this week, which I actually just showed you. So, but nevertheless, we'd really appreciate it if you subscribe anyway. Let's take a look at the markets, a little bit closer look at the markets. Pursuant to what I just said, we're in the 1 hour chart here. This sell-off all night, see this buying? This buying could be short covering, could be people buying to get long, but it's all buying in anticipation of the New York Open, because there's a lot of money. It's a nightclub. The nightclub is about to open. The nightclub is opening at 9:30, and so people rush in, and that's why the market rallies at 9 o'clock. If the market rallies at 9 o'clock, if you want to watch a little tape, have a little entertainment, watch the 9 to 9:30, it'll start to rally, and then 9:30 to 10, it'll rally more. You want to see what happens in the gold and silver market for the next 3 days from 10:30 to 2. Because that'll tell you what the market really thinks. That first hour is the bridge and, if you're a New Yorker, it's the bridge and tunnel crowd coming into the nightclubs. Okay, this is the bridge and tunnel crowd. If you're not familiar with that, it means the tourists. Okay, so that's pretty much it. Look, this has been a tremendous run. It's by no means over for the next 4 years. I just want you to, if you want to stay committed, know what we're getting into for the next month or two. You know, gold could easily rally after the election $500. I'm not, but I just can't bet on that, because the government is watching. They know. They don't want to. If gold goes up $500, the world sees the U.S. as unstable after an election. So there will be controls in effect to keep the price of gold stable, whether it be raising margin requirements, whether it be the plunge protection team operating on the commodity side, whether it be just, good old-fashioned patriotism. Who knows? But it happens. And if this election is contested, if it's not a blowout in either direction, I should say it will be contested. And it will be contested between now and January 20th. And so depending on how that fight goes, gold's going to have whippy ranges. All right. I'm Vince. Have a great day.